We're calling this one breaking the volatility code. Speed matters more than size. Let's see where the team's going with this one. So recently, we've seen certain stocks. We're going to, as an example today, we're going to use Nvidia, make some huge outlier moves. These types of moves are generally bad for short premium trades. And of course they are. You know, when a stock like Nvidia drops from near 150 to near 120, it's pretty hard to defend that move of $30 when the expected move over that period of time is closer to 15. You know, that's the challenge, 2 times the expected move. And as you can see on the right-hand slide there, you know, the volatility in Nvidia just popped up. And so you have a double whammy going on. Stock moving outside the expected move and volatility expanding. And when you're short premium, no bueno on that little combination there. That's where you get into, that's where I get into trouble, Chris. Those are my nightmare scenarios. Let's go next slide, Beth.
That's the double tap, as we call it, right? You short the puts, and then all of a sudden the market sells off with a vol expansion. Yeah.
So the outlier moves in Nvidia caused Monday, just this most recent Monday, caused the vol spike to 72 from 48 of the previous trading day, with an expected move range as shown below. You know, obviously, we're using Nvidia here because the simplest way to say, why do you choose Nvidia? Well, we could choose it because it's a $3.5 trillion stock, but we can also choose it because it had the most option volume by a lot. I think there was one day last week where we did 10 million Nvidia contracts industry-wide, 10 million. You know, I first started this business, we were doing 1 million contracts a day. It was a lot. Now we're doing 10 million contracts in Nvidia. And yesterday, I think we did 5 or 6 million Nvidia, or 7 million, some crazy numbers. That's why we chose it. Let's go to the next slide, Beth. So with an IV rank of 54 and a March 21st, that's regular March expiration, 30 delta strangle of $10.45, using only 5,500 buying power. Now, if you have a March 30 delta strangle of 10.50, you know, you can understand why a $30 move will mess you up. With more than a 60% win rate. That's a derivative of Black-Scholes, that number. So it may seem like a tempting trade to put on. However, we need to make sure we are considering all risks as well. Now, one thing to note here, Chris, first of all, nothing is mispriced. Let's be very clear about this. Nothing is mispriced. Nothing is ever mispriced. And the other thing is, when we talk about these kind of trades, the one way to defend yourself, to protect yourself is, or protect against a $30 move in Nvidia, is just to stay small. That's your way. That's what you can control. Let's go to the next slide. So at first glance, a short strangle in Nvidia seems to have a typical risk reward profile, since implied volatility has overstated historical volatility on average. We included the SPYs and the Qs, IV and HV, for reference as well. This also has to do with the conversation we were having before when Julia was on the show this morning. But just to give you some kind of comparison, average implied volatility, which is forward-looking expected in the Qs, was 23, the actual historical 20. SPY, again, 3% difference, and between 18 and 15, and Nvidia a little bit less, 49 to 47. If you looked at this, you'd say, okay, the risk reward profile is pretty similar across the board.
Similar across the board, but also in line with the understanding that IVs typically overstate the historical volatility. So nothing really unusual there.
Nothing at all. Just wanted to show you that it compares to what it looks like in the ETFs as well. Let's go to the next slide, Beth. However, when digging deeper, it seems like the number of outlier moves, as well as the magnitude of the outlier moves in Nvidia and the diversified indexes, were nearly identical. Who would have thunk that? See, this is where I get messed up. I look at something like Nvidia and I'm like, there is no way that the daily moves that exceed 2 standard deviations, which have less than a 5% chance of happening, would be the same in Nvidia and SPY and Qs since 2017. Like, this is the slide that messes me up the most, because I've been trading Nvidia and it feels like all the outlier moves are in Nvidia.
It feels like only outlier moves exist in Nvidia.
Yes, that's what it feels like.
When Gad sent this over, right? Or when Gad sent this over, I said, wow, that's shocking. But that goes on to the bigger point here about the idiosyncratic risk in trading some of these single stock names.
It's like wild to me that the SPY and Qs have almost the exact same number of occurrences, and the average standard deviation move when you exceed 2 standard deviations. Wild to me. Let's go next slide, Beth. So then, why does it seem for most that Nvidia is riskier to trade than the SPY or the Qs if the outlier risk, the number of 2 standard deviation moves, and the overall risk, the IV overstatement for both the index and Nvidia are nearly identical? Because they're all about the same. That's why we did this study. All these numbers are the same. So why does it seem like you take so much more risk when you trade Nvidia? Because the implied volatility is higher? I mean, I'm just, throwing it out there. Let's go next slide.
Throwing it out there to me. Well, I think we're going to find out the answer.
And the answer lies in the velocity of implied volatility. We talk about velocity a lot on this network. And the reason we do is because velocity is the velocity of risk is what we call basically is what option pricing skew is. So the velocity of implied volatility, this translates into how quickly implied volatility can spike on any given day. We can quantify this by looking at the average and the standard deviations of historical daily implied volatility increases. So really the answer is in how fast implied volatility can move. Nvidia can go from 40 to 70, but it's tough for the indexes to go from 20 to 40. And that's the difference. Let's go next slide. So when Nvidia implied volatility expands, and here's the key, it expands by 57% more than the SPY and 60% more than the Qs. In addition, Nvidia implied volatility has double the range of expansion potential than the QQQ IV does. So, however, the minimum and maximum daily increases are almost identical. So this is where basically the additional risk comes into play. Now, you get paid for that additional risk because if you sold the same strangle in the Qs, the same delta strangle, you'd collect about a third of the amount of capital. Right. That's the difference. So the average of the historical daily implied volatility increases is about, let's call it double in Nvidia over the other ones. And everything else kind of stays exactly the same, except the standard deviation of historical daily volatility increases is higher. That's it, about 50%. Showing you where the additional risk comes and why you get paid the additional money for trading an underlying that has higher volatility than the indices.
It's not just Nvidia, right?
It doesn't.
Any stock would fit this profile.
It's not just Nvidia. We just use Nvidia as an example. They're all the same. And this is why if you trade some of these equities, you get paid more money. You take more risk, you get paid more money. That's exactly how it works. This whole industry is theoretically spot on, but you take more risk, you get paid more money. Let's go next slide. So the reason why trading single stocks tends to be more risky and has more potential reward, that's the offset, than trading ETFs is due to the large potential velocity of IV expansion. As shown in our studies, single stocks also have a tendency to have more outliers than ETFs, but in Nvidia's case, the main risk is to be aware of its IV expansion risk. That is one solid study.